Forget everything else everybody else says about market structure breaks and shifts and all that stuff. This is it, okay? This is the brass tacks. There's absolutely nothing else that you need to know about it. I promise you. If they add anything to it, it's just because they want to sound and look different. But this is the algorithmic perspective of a market structure shift intraday. Now, keep this price level in mind. So it's essentially 14,600 and 14,820. We're just eyeballing it, okay? Now, dropping all the way down into a 2-minute chart. This is that same particular day. Here's those relative equal highs. And this run down here, okay? If you recall, 14.6 and around that 14.860 or so, okay? If you look at this market structure, without having the levels on your chart, it's easy to get lost in all the quote-unquote noise, the uninitiated. If you look at this price action here, when we had this low form, right before this low was formed, there's a swing high right there. Now, in the first mentorship video I gave you, I mentioned that high frequency trading algorithms will use market structure on a 3-minute, 2-minute, and 1-minute chart, many times sub 1 minute. That would be like 45-second, 30-second, 15-second intervals, okay? What the algorithms are actually doing, and this is also going to correct a lot of people out there because they put out misinformation. It's so nonsensical, but I'm challenging you to go into your charts and see if this is not what's actually going on, because it happens every day. If high frequency algorithms are operating every single day, then these signatures will be in the chart, okay? If you look at this short-term high here, right before this low formed, when this high is taken out right there on that candle, that's significant. Only if this run down here has traded into sell stops, okay, below an old low of some kind. It could be a double bottom, it could be a single low, okay, but it's got to be trading under some retail idea that would be viewed as support. Up here, the same thing. We're trading above highs, so we know that above old highs, a neophyte's perspective will be, these are unknown orders, so therefore that's a flawed perspective on price action. How do you know there's liquidity up there? How do you know there's buy stops up there? It's just logic. It's simple. Look at the chart. When this run above these relative equal highs happens right there, you're anticipating a market structure shift. You're not forcing it. You're not trying to get ahead of it, okay? I don't think any of you are going to have the skill set to do that. There are ways to know when to sell short right above that and not even wait for the shift in market structure. Just like there's ways to know to be a buyer down here without seeing that short-term high broken, then looking for a buy. Over here, the opposite. See this swing low? Let me go back to this for a second. We have this high on this candle, then we have the candle right after that here, the highest one, and then the lower high of this candle here. So that's a swing high. Very simple little pattern, but it means a lot when it's in the proper context. When this high is broken with this particular candle right there, that is significant only on the basis that we have taken liquidity out of the marketplace. That's it. So when it broke this short-term high, this is more meaningful. And then the market will start to seek buy stops, okay, or buy side liquidity. That would rest above here, here, and here. All I'm going to do is add a few annotations, and this is about as extensive of lipstick we put on our chart. I know it's shocking, right? Can you still see the candles? Because it might be a little obstructive. I'm being facetious. You see these guys out there with these charts that have graffiti all over it. You can't even see the price candle. Nothing. You can't even see any of it. But there's all kinds of overlays of all kinds of nonsense, which means absolutely nothing because algorithms could care less about any of that stuff. Triangles, harmonic this, crabs. It's crazy, I know, but hey, everybody's got to have a religion. So here's those sell stops. So this little area here that's shaded in, that's a area where sell stops would be residing below that 14,600 level, okay, on that 15-minute time frame. So the market dove into that liquidity, and you may or may not know that is a buy. You don't need to. You anticipate a shift in market structure. When the market rallies above, when does that happen? On this candle right here. See that little light bulb? That's when you're thinking, okay, now I have a condition in the marketplace that I might see an opportunity intraday. Let's see if there's further evidence to that. Short-term high is taken here. We traded above it. It does not need to close above that. Okay, real important. Once that candle closes and this candle opens, you're going to monitor this candle. And you want to see, as soon as this candle closes, does it create that fair value gap? If it creates a fair value gap, again, that's a candle at the high, one single pass up. Next candle has a low that doesn't completely overlap all this. That's a fair value gap, real simple, okay? This candle is where you would look to potentially trade at the earliest because now there's a gap there. The market trades down into that, boom, takes off. Here is insight that everybody needs to understand because they're out here running around on YouTube trying to teach order block theory. Order blocks, okay? I invented it. It's mine. No one talked about it before me, and I first mentioned it in 2010 on baby pips. Prior to that, 1996, I was only teaching it to people one-on-one in teachings. That's it, okay? You can't find it in books prior to that. It's mine. No one else taught it before me. It is mine. So I'm going to correct all of you today so that way you can teach your people correctly and not hurt them. See these down closed candles? See that? That's all one continuous order block. What's it doing? It's inside that pool of liquidity, sell stops. Where's the open on that series of down closed candles? Right here. That's the price level extended out in time. Boom. So inside this fair value gap, this opening price on the order block, that's your buy, plus 3 pips or whatever for spread. And that's what you would use for a limit order. That's pretty neat, isn't it? Well, price starts to run where? Above the highs where buy stops would be here, above this high here, and above this high here. So the buy stops above here that was taken, this swing low forms once this candle closes. So this candle we're watching, does it go below that short-term low? It does. So now we have a shift in market structure that is now bearish, only because we've taken buy stops. Okay? Fair value gap forms, the market rallies up into that, you go short there. What are you looking for? Below here, sell stops. Below here, sell stops. Below here, sell stops, and in this fair value gap here. So if you are in a position that has multiple contracts, or say you have a Forex trade, because this works in Forex too. It's not just limited to futures. Again, I'm just using this asset class because I cut my teeth on these markets. When everybody else was still in elementary school that's trying to teach today, I was trading the S&P. I probably sound like a young guy, but I'm actually getting ready to turn 50. So I've been around for a long time, 30 years, this November 5th, 30 years, that's 3 decades. And the things I'm teaching you, I'm not teaching you one trick pony insight. These things work on all asset classes. Now, I'm not going to co-sign the crypto markets because that only my students are reporting that this stuff works there. I don't even mess around with it that much to know, okay? But you can take partials below here. I really wouldn't do it there, but below here, here, and I know some of you are saying, well, why wouldn't you take them below their ICT? Well, if you're trying to get short here, that's not really that much movement. So if you're going to take something off your trade below that low, why not just try to reach for that one? And you could get it there, right here, okay? And then below that low is nice as well. Below this low, and this is what I mentioned on the first lesson, okay? Elements to a trade setup. This is below the 50 level of this high and that low. Okay, so 50% level, that's what we're targeting. Now, this candle's low was the high end or first objective inside this gap. So that's your target. You're going to look for that. So you're looking for low-hanging fruit, the easiest target to get to. You're not trying to be perfect. And you grow into eventually holding to see if it will fill in that gap. Okay, this fair value gap. In other words, going down to this candle's high. That's something that you strive for over time. If you understand what I just showed you here, that's a very simple process of looking for, number one, liquidity, gauging what happens without having to know for certain, because you don't know. You're not going to know until the market shows its hand. This is it showing its hand. So we're looking at the swing lower here. Market breaks down, trades break back up into this fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points of execution that you could trade on, and then dives. See these two candles here? That's one consecutive bearish order block. The opening price, extended out in time. Why is this a good bearish order block? Because it has that gap, and it's taken liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's interpretation of my concept, the order block. That's it. Okay? What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is. Okay? What it is, it's a change in the state of delivery. Okay? It's a change in the state of delivery. The market's being offered higher, 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 higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level, but that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down closed candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. Same thing here. Buy side is being offered until that opening price is violated right there. Then the change of state of delivery occurs. Now the market's going to be doing what? Offering sell side liquidity. What's that mean? It's going to start going lower and attacking the sell stops. All the sell side liquidity. It's offering it to the marketplace. That's what's happening. That's what the algorithm is doing. That's what the algorithm does. Okay? You buying and selling, me buying and selling, everybody over there on Reddit is not going to change anything at all. It's not going to do anything. And the argument that defeats all that buying and selling pressure is, how do you argue against the bull squeeze and the bear squeeze? There's a short squeeze going on. The market's rallying up when it's been bearish. That's just their cop-out. That's their way of saying, well, you know, everybody's shorting, and now they're covering. So there it is. And I learned the same thing, folks. I believed all that garbage. 2,000 plus books. I know what those books told me is what you are learning too. Because the same people teaching today, retail garbage, Elliott Wave this and that, it's all stupid stuff, man. It has nothing to do with why these markets are doing what they're doing. Zero has nothing to do with it. Don't worry, I got proof today. But the market goes down to that 50% level because it's going down to what? I teach you. What did I say in the first video? It's going down from a premium market relative to this low and this high. 50% is here. That's equilibrium. So it's going to go down to a discount. And that's that gap right in here. It doesn't look like a gap so much here. But if we go back up one more time, that's that single opening right there. On a 2-minute chart, but then on a 1-minute chart, it's 2 candles that make that up. But you're going to have to do is go through a progression of going from the 3-minute, 2-minute, and 1-minute chart, and you'll get your market structure and your areas of where it wants to look for an imbalance or old low, old high, and it just makes it easy. But just a real nice delivery there. And here's the lipstick on it on the 1-minute chart. Swing high is broken. Market structure is now bullish. Rallies. Taking buy stops, taking buy stops, taking buy stops. This right here, these highs right here, is just staying below that low. It's building up more interest that this is what? Resistance. That is engineering liquidity. That way, when this runs above it, those individuals that know what you're learning today, they know that that's a pool of liquidity for buyers coming in at a high price. Why is that useful? Because smart money that bought down here, or here, or here, or here, or here, that's where they sell to high-seeking buyers. It's not hard logic, folks. It's not complicated. Okay, it just feels complicated because you see other people trying to teach something and you hear or read in the comments, you're teaching it better than ICT does. No, you don't. No, you're not. You're not doing it. You're actually teaching it incorrectly and without the real context of what it is that you're missing. But I get it. You think every down closed candle is a bullish order block and up candle is a bearish order block, and that's not the case. Look in here. Okay, for the guys that say I did not take trades or I didn't trade this way, you see that gap right there? See that? See that down closed candle right there? That's your order block. Boom, buy it right there. What about this? Right here, dropping down. All these candles here are more significant if you look at it on a 2-minute chart. See that? It becomes one order block right in here. Buy it, sell short, buy it again. We got up into the stops, sell short, reverse, then ride the larger swing down. Don't listen to these yahoos out there that say that I'm not proving something to you. I'm proving it. That's what I said I was going to come out here this year and do. That's this whole point of being here this year. It's my 30th anniversary, November 5th. I've been a trader in the markets, living and breathing this stuff for 30 years. You're not really in any position to demand anything from me. I enjoy doing this, but I don't need to provide any kind of proof to you either. But I'm loving it this year. I'm slowly putting it out there and enjoying all the naysayers and the things they're saying. And it's just fun because they have no idea what I'm about to bring this entire year. None of you are going to doubt anything. So the 1-minute chart, just a real nice delivery here as well, filling in that fair value gap, changing the state of delivery. Now it's offering sell side. What's that mean? It's going to match up sell stops. It's going to keep going below old lows and into an imbalance until we get down to a discount. Is that hard? Is it hard to see what I'm showing you here? Pretty clean, isn't it? Clean chart. Now, I don't have all these things on my chart when I'm watching price because I already know what I'm looking for. And I don't want to have any distractions, and I don't want to have a level or some kind of annotation that's going to keep me thinking only with that perspective, okay, or that idea. It allows me to be fluid with what the market's actually doing versus going in and saying, okay, this is what I think is going to happen, and this is the only thing that can happen. You understand what I just did there? I allow myself to be flexible, whereas if you have all these things you're putting on your chart, you're only seeing your will be done. So I keep my charts clean. And then I add the annotations so that way my students can see what the internal dialogue in my mind was while watching price do what it does naked. There's nothing on the charts at all when I'm trading. Zero. Nothing. Okay? So with that, I want you to think about how this is useful. Okay? Number one, you're looking at London highs and lows, the session for London open. Okay, for instance, like 2 o'clock in the morning to 5 o'clock in the morning. New York time. Every time I tell you, just always set it with New York local time. 2 o'clock to 5 o'clock in the morning. That's your London session. What's the highs and lows of that session? Okay, that's important because the market's going to probably sweep above those highs or sweep below those lows and create situations like this. Okay, and the New York session is 7 o'clock in the morning to 10 o'clock in the morning, New York local time. Okay, what's the session high and low for that? And do the same thing for Asia. Okay, 7 p.m. to 9 p.m. And that's it. Those are the 3 times of the day that I'm looking for specific key highs and key lows. And any intraday high and low forming right before the equities open at 9:30. Pretty easy, right? The hours of operation, again, are generally between 8:30 in the morning to 11, but it can be extended all the way to New York lunch, noon. I do not tend to take trades after noon local time, New York. All right, so we talked about internal range liquidity, and internal range liquidity is looking for short-term lows or short-term highs inside a price leg that we're retracing back into. Okay, that's all it means, internal range. Liquidity is a short-term high or low with stops above or below it, or an imbalance in that same range of price action. And I taught you market structure shifts. Showed you exactly all that's necessary. That is all that you require. And the skill set of identifying pools of liquidity, that is going to be something you learn rather quickly just by going through old data and looking at the times of the day I gave you in this lecture. All right, your homework is you're going to go through your E-mini futures intraday charts, and you're going to be looking for stop hunts that lead to market structure shifts intraday. You're going to log your examples with your own annotations for your study journal. So what I showed with the break in the market going higher and lower above old highs or lower below an old low, that's running for stops. That's a stop hunt. Then you're looking for that signature for the market structure shift on the 3, 2, or 1 minute charts. Okay, if you look for that between 8:30 in the morning to noon, New York local time, in the E-mini markets, or if you're watching the micro markets, the same logic exists, okay? But you're going to start going back from today and go back as far as the data will allow you. The more you do it and you annotate your charts, the more experience you're going to have. And it's pseudo experience, yes, but you're teaching your brain. I use this analogy a lot with my paid mentorship students. It's like hunters, okay? To know where you're going to find a deer, if that's what you're going to go out and hunt, you need to know how to track one, okay? Or sit up in a tree stand and wait for it to walk by. But usually they go out and they walk around in the woods and they look for tracks. Would you know what a deer track looks like? Before I was shown one, I didn't know what it was, okay? But because I'm showing you what it looks like, that's all this lesson was predominantly focusing on, is the actual view of what it looks like, the details. What you don't need is anything above and beyond what I've shown you. The only thing that you need is what I've shown you here. It's simple, it's straight to the point, and I'm only talking to that way you understand that this is all that is required. Notice there is no commitment of traders. Notice there's no breakers. Notice that? I've stripped it down to the chrome. Now, this isn't the only way you can trade, but I'm showing you something that I think personally, this is my opinion, this is so universally simplistic. All of you should be able to do this one. Okay, in my opinion, I think this is it. And that's why I more or less built it, because I think my daughter, which has zero interest in trading, I think that this is going to be easy for her to see it and understand what to look for. It doesn't have a lot of moving parts. Notice that? It's very specific times of the day, specific highs and lows you're going to look for. It's simple, but you won't appreciate how simple it is until you go back in your charts and you annotate your 15-minute time frame for your buy-side liquidity pool and your sell-side liquidity pools,